What if I told you that the most famous rule protecting your investment portfolio is, well, it's basically legally designed to be broken?
Yeah, it's a huge paradox, honestly.
Right. I mean, today we are looking at the FINRA 5% rule. It's this guideline from way back in 1943.
Way back.
Yeah. And it supposedly dictates exactly how much a broker can legally skim off your trades.
But the reality is a lot messier.
Exactly. When you actually look at the mechanics of the financial system, the loopholes they use to double or even like triple that percentage are incredibly wide.
They really are.
Yeah.
You've got this rigid-sounding number, 5%, acting as this ultimate benchmark for fairness.
Right.
But then the vast majority of modern market participants, they operate entirely in the gray areas around that number.
Which is wild. So welcome to today's deep dive. We are thrilled to have you here in the room with us. We've got an extensive stack of notes and regulatory history today.
Lots to get through, yeah.
Definitely. And we're covering the dual nature of this FINRA 5% rule. So our mission for you on this deep dive is to decode this seemingly dry financial guideline and reveal how it actually functions as a crucial two-part shield.
Right, two parts.
Yeah, so the first half is built to protect your wallet from excessive hidden execution fees.
And the second half, which is, strangely enough, it's a mathematical framework designed to protect your overall portfolio from just catastrophic unrecoverable losses.
Right, and that makes it one of those rare regulatory frameworks where understanding the actual plumbing of the rule fundamentally changes how you interact with your own wealth.
Absolutely. It's really about shifting from just, passive participation to taking active control of your financial exposure.
Okay, so let's unpack this. We are dealing with a regulation established by FINRA's Association Board back in 1943.
A very different time.
Seriously, I mean, the premise was just to set a ceiling on broker commissions, markups, markdowns, basically, to ensure investors were getting a fair price. But what I find really telling is the origin of that specific 5% figure. Because in 1943, we obviously didn't have high-frequency trading algorithms or, fiber optic cables.
I know, not at all.
This was an era of paper trade tickets, physical phone calls, literal messengers running across trading floors.
Yeah, the labor cost of execution back then was exponentially higher.
Right.
So when the Board of Governors established that benchmark, they didn't just, invent the number out of thin air to sound authoritative.
They actually did the math.
They did. They conducted these massive market studies based on actual customer and broker feedback.
Wow.
Yeah, they analyzed the volume of executed transactions and figured out that the vast majority of trades that people considered mutually fair, they fell under a markup of 5%.
So it was just a reflection of the physical overhead.
Exactly. The overhead required to physically match a buyer and a seller in this heavily analog market.
And what's crazy is that despite the market evolving into this digital microscopic latency environment, the board has just continuously reviewed and reaffirmed that 1943 philosophy over the decades.
Yeah, they really stuck to it.
But that brings up a massive structural friction point. I mean, I have to push back on the very name of the rule.
Oh, I know where you're going with this.
Right. Like, if we read the regulatory framing, it explicitly states that this does not set forth any concrete criteria for calculating commissions.
Right, it doesn't.
It is officially classified as a guideline. So how do regulators justify calling something a rule when legally it just functions as a suggestion?
Well, what's fascinating here is that the terminology really reflects the sheer complexity of market liquidity.
How so?
Well, think about it. If regulators enforced a rigid, unyielding law, a hard cap under all circumstances, it would completely fracture the system.
Oh, because it would just break down.
Yeah. It would force brokers to refuse complex or, say, low-value trades because executing them would mathematically guarantee a loss for the firm.
Nobody wants to work for free.
Exactly. So the philosophy behind the guideline is really built on flexibility. It allows firms to deviate from that 5% standard based on 5 very specific factors of market friction.
Okay, let's deduce what those factors are, because if my broker is stepping over that 5% line, I definitely need to know the mechanical justification for it.
Right. You want to know why.
Yeah. So obviously, the total value of the transaction has to be a primary factor, right?
Oh, absolutely.
Like if an institutional client is moving a $50 million block of equities, the economies of scale dictate the broker shouldn't be charging a flat 5%.
No, of course not.
That would be an astronomical, $2.5 million fee for just a few keystrokes?
Yeah, that wouldn't fly. So transaction size is absolutely one of the core deviation factors.
Yeah.
Larger transactions inherently qualify for deeply discounted pricing, way below that ceiling.
Makes total sense.
And then a second factor is the price of the security itself.
Oh, okay.
Because moving a highly priced equity requires a totally different capital commitment than, say, moving penny stocks.
Right, right. That makes sense. And I imagine the asset class itself creates friction, too.
It definitely does.
Like executing a trade for a highly illiquid, obscure municipal bond or some complex derivatives contract, that has to require way more overhead and matchmaking effort than just buying shares of like a massive mega cap tech stock.
Exactly. Which is why the type of security involved is the third factor. The more complex the instrument, the higher the justified markup.
Okay, so that's 3.
Right. And the fourth factor centers on the overall value of the member's services.
Okay, so what does that mean in practice?
Well, we're looking at the difference between a premier wealth management firm, providing extensive research, custom financial modeling, dedicated advisory access.
Oh, full service deal.
Yeah, versus a discount execution-ready platform where you're essentially just using a self-checkout lane.
Right.
You pay a premium for the human intellect and the infrastructure attached to the trade.
Okay, which leaves the final factor. And this is the one that sets up a totally wild loophole in the execution framework.
It really does.
Yeah, so the final factor is the actual cost of executing the transaction.
Right.
Because some firms impose a hard minimum transaction fee just to cover their basic operational overhead.
Yeah.
Right? Like keeping the servers running, maintaining compliance, processing clearing paperwork.
Yep.
And there's an example in the notes of how this plays out that is just staggering.
You're talking about the $1,000 trade scenario.
Yes. Let's say you decide to buy 100 shares of some hypothetical company, and it's priced at $10 a share.
Okay.
So that's a total transaction value of $1,000.
Right.
But your broker-dealer has a minimum execution fee of $100.
Which is common.
Right. So you are paying $100 on a $1,000 trade. That is a 10% commission. You're suddenly paying exactly double the so-called 5% rule.
Yep.
But under FINRA guidelines, this is perfectly ethical.
It is. And the reason is that the ethical linchpin of the entire financial regulatory system is transparency.
Transparency.
Exactly. The 5% rule is suspended in this instance because the client was informed of the transaction minimum in advance.
Ah, I see.
Yeah, the broker explicitly disclosed their baseline cost of doing business. And the moment you, the investor, agree to that baseline, the percentage relative to the trade size basically becomes irrelevant in the eyes of the regulator.
Wow. It actually reminds me of, like, booking a private room at a high-end restaurant.
Okay, I like that analogy.
Right. Like, a lot of these places have a mandatory minimum spend for the room. Let's say it's $500.
Right.
You go in with a colleague, you aren't really hungry, so you just order 2 side salads and maybe 2 glasses of sparkling water.
That's a very light dinner.
Exactly. And the actual retail value of that food is maybe $40. But at the end of the night, you are still getting a bill for $500.
Because of the minimum.
Right. And if you only look at the salads, it feels like a massive ripoff. But the restaurant isn't hiding the cost of the lettuce. They are charging you for the overhead of occupying that private dining experience. You know, utilizing their wait staff, taking the room off the market for the evening.
That is exactly it. The minimum execution fee functions the exact same way. FINRA's objective isn't to force brokers to lose money subsidizing small, complex trades.
Right.
Their objective is just to prevent hidden price gouging.
Ah.
So as long as the invisible toll booth is made visible before you drive through it, the regulatory burden is met.
Okay, so understanding the logic behind why brokers can deviate from the baseline leads us to the actual plumbing of the market.
Right, the mechanics.
Yeah. When a fee is applied, what specific mechanical action are we actually paying for? The regulatory text outlines 4 distinct types of trades covered by this guideline, and honestly, the terminology can feel a bit impenetrable.
It's a lot of jargon, yeah.
So let's strip away the jargon and look at the actual gears turning behind the screen.
Sure. So it all comes down to the risk exposure of the brokerage firm at the exact moment of execution.
Okay.
The first type is what they call a principal transaction.
Principal, got it.
Yeah, and in this setup, the broker-dealer is operating basically like a traditional merchant warehouse. They hold a massive inventory of securities on their own books.
Like actual shelves of stock.
Exactly.
Yeah.
So when you want to buy, they sell directly to you from their vault. Because they are absorbing the market risk of holding that inventory, meaning, the asset's value could tank while they own it, they charge a markup when selling to you, or a markdown when buying from you.
So they're essentially buying it wholesale from the broader market and selling to you at retail.
Precisely the mechanism, yeah.
Okay, what's next?
The second flavor is an agency transaction.
Okay.
Here, the brokerage firm carries zero inventory risk.
Yeah.
They do not own the security.
Okay.
They are strictly acting as your agent, basically a middleman going out into the broader market to find an external buyer or seller to match your order.
Oh, I see.
Yeah. And for providing that matchmaking service, they charge a straightforward, transparent commission.
But the friction there is the reporting and the margins, right? Which brings us to the third type, the riskless transaction.
Yes, the riskless principle.
Right. And this is where the plumbing gets really interesting, because a riskless principal trade happens when a firm receives an order from you, goes to the open market, buys that exact security for its own proprietary account, and then instantaneously sells it to you.
Right, back to back.
My question is, why jump through those hoops? Why act as a principal for like half a second instead of just acting as an agent and charging a commission?
Well, it really comes down to regulatory reporting and profit margins.
Okay.
By executing a riskless principal trade, the broker utilizes an offsetting customer order to completely eliminate their own market risk.
So they can't lose money on it.
Right. They aren't holding the asset long enough for the price to move against them.
Yeah.
But by structuring it as a principal transaction, they are legally permitted to capture a markup rather than a commission.
Oh.
Yeah. Historically, markups have different disclosure requirements. They can sometimes be bundled into the execution price differently than a starkly visible commission line item.
So it's less obvious to the client.
Exactly. And it allows the firm to leverage their clearing infrastructure for a much better margin.
So it's entirely a structural maneuver to secure their compensation. That makes sense.
Yeah.
And the fourth type is the proceeds transaction.
Right.
This is when a client directs the broker to sell a security and immediately use the cash generated to purchase a completely different security.
Yes.
And the regulatory framework places this massive, bolded emphasis on treating this entire chain of events as one single transaction for the purposes of calculating the 5% fee.
Because that distinction is the absolute bedrock of investor protection and portfolio rebalancing.
It has to be, right? Or else the fees would compound aggressively.
Oh, rapidly, yeah.
It's sort of like a car dealership. If you want a new vehicle, but you need to get rid of your old one, you don't go to the dealer on Monday, sell your car, pay a processing fee, receive a check, and then, return on Tuesday to buy the new car with that check and pay a second processing fee.
No, nobody does that.
Right. You conduct the entire operation concurrently. You trade in the old vehicle, the value is instantly applied to the new purchase, and you sign a single stack of financial paperwork.
Exactly.
So the regulation explicitly prevents the broker from artificially separating the sale and the purchase just to double dip and charge you 2 full commissions for rotating your assets.
Right. It stops the artificial inflation of fees through technicalities.
Which is great.
It is. But, while we're mapping out where the guideline applies, we also have to highlight the specific environments that bypass this regulatory umbrella entirely.
The exemptions.
Right. There are major exemptions where the 5% philosophy just takes a backseat.
Okay, let's explore those exemptions. The most prominent one involves securities offered under a prospectus. So we're talking about major liquidity events like initial public offerings or the continuous issuance of open-end mutual funds.
Right.
But why does a guideline built to cap fees suddenly disappear during some of the most capital-intensive transactions in the entire market?
Well, because the mechanism of transparency fundamentally changes in those situations.
Okay, how so?
Remember that FINRA's ultimate goal isn't actually the 5% cap. The goal is informed consent.
Oh, right.
And a prospectus is this grueling, legally binding document mandated by the SEC.
I've tried to read them. They're dense.
Exactly. It details every conceivable risk, the corporate strategy, and most importantly, it exhaustively outlines every single fee, underwriter spread, and commission associated with bringing that security to market.
Oh, so it's all right there in black and white.
Exactly. Because the pricing structure is aggressively documented and scrutinized before the public ever even has the option to invest, the regulatory body considers the transparency mandate fulfilled.
I see. The market is just given the exact data needed to price in the overhead, which basically renders the baseline guideline redundant.
You nailed it. The disclosure is so complete that the market forces just take over.
Interesting. And on the personnel side, the rules exempt individuals functioning in strictly clerical or ministerial roles.
Right.
So administrative staff processing the paperwork who have absolutely no hand in advising on or executing the trading strategy, they aren't bound by the same registration and regulatory fee structures.
Exactly. And additionally, transactions executed exclusively on a formalized securities exchange, those are often governed by the exchange's own stringent internal bylaws.
So they supersede the FINRA rule.
Exactly. They take precedence over this broader industry guideline.
Okay, here's where it gets really interesting.
Oh, yeah.
Because you can spend all day analyzing broker fees, markups, minimums, and prospectus exemptions. You think you understand the FINRA 5% rule as this mechanism for protecting your capital from the people managing it?
Right. Defending against the broker.
Exactly. But then you pivot the lens and you realize this exact same percentage has an alter ego in the financial world.
It does.
We move from a conversation about defending your money from your broker to defending your money from the unpredictable violence of the market itself.
Yes. The 5% concept completely shifts from a regulatory guideline to a core tenet of modern portfolio theory.
Wow.
Yeah, in the context of investment strategy, the 5% rule refers to the philosophy of diversification.
Right.
The doctrine states that no single security, no specific mutual fund, no individual company stock, and ideally no single industrial sector should ever comprise more than 5% of an investor's overall portfolio.
Which mathematically translates to 1/20th.
Exactly.
You are basically consciously fracturing your wealth into 20 distinct, isolated compartments.
The 1/20th philosophy. If we connect this to the bigger picture, this is arguably the most vital mathematical defense mechanism for long-term wealth preservation.
I believe it.
And the stark difference here is enforcement.
Oh, right.
Yeah, no regulatory agency oversees this version of the rule. FinCEN are not going to suspend your trading account if you decide to dump, 60% of your net worth into a highly volatile microcap tech stock.
Though the math suggests your future self will severely regret that decision.
Very likely, yeah.
Let's actually run the numbers on why that threshold is so critical. Let's say you have a portfolio of $100,000.
Okay, standard baseline.
Right. If you ignore the rule and you put 20%, so $20,000 into a single company,
Okay.
and that company goes bankrupt, your portfolio immediately drops to $80,000.
Rough day.
Very rough day. And to just get back to your original baseline of 100,000, that remaining 80 grand now has to generate a 25% return.
Wow.
Yeah. And in normal market conditions, achieving a 25% return could take years. The drag on your compounding growth is just devastating.
It really is. But consider the alternative using the 5% framework.
Right. So if you follow the guideline, your maximum exposure is just $5,000.
Okay.
If that company goes to zero, your portfolio dips to $95,000. To recover back to par, your remaining assets only need a return of roughly 5.2%.
That's a huge difference.
Massive. You can often recover that loss within a few quarters of standard market performance. Compounded over a 10 or 20-year retirement horizon, the 20% hit destroys your wealth trajectory, while the 5% hit is nothing more than a statistical blip.
It acts as a mathematical firewall. You're engineering resilience into the system.
It is exactly like the bulkheads on a nuclear submarine.
Oh, I love this comparison.
Right, because the hull is divided into separate watertight compartments. If a torpedo breaches one section, that specific compartment floods, and you lose whatever equipment is in there.
Which is bad,
So
obviously.
it's a localized disaster, yeah.
Yeah.
But because the bulkheads hold, the flooding cannot spread to the rest of the ship. The submarine maintains its buoyancy, the reactor keeps running, and the crew survives. If you build a submarine without those bulkheads, if you just put all your wealth into one giant undivided space, a single breach sinks the entire vessel.
That is the perfect visualization of the risk management dynamic.
It makes it so clear.
It really does. Companies inevitably fail. Entire sectors face regulatory collapse or, technological obsolescence. The 5% rule acknowledges that you cannot predict which asset will fail, but you can absolutely control the maximum damage that failure inflicts on your financial survival.
So what does this all mean for you, the investor managing your own capital today?
That's the big question.
How do we synthesize these two vastly different mechanics into a coherent strategy? Well, it reveals that the true nature of the 5% rule is a unified philosophy of preventing excess. It's a dual-layered shield.
It is. The first layer requires you to demand a transparent framework for execution costs, basically preventing excessive broker extraction.
Right.
And then the second layer requires disciplined, calculated diversification, preventing excessive risk exposure.
And understanding this architecture gives you remarkable leverage.
Totally.
It means the next time you review a trade confirmation, you aren't just passively accepting the numbers on the screen.
You're actually reading it.
Yes, you can analyze the markup and deduce the mechanics, like, is it a principal or agency trade? Does this fee align with the 5% guideline? And if it exceeds it, did I knowingly agree to a minimum overhead charge beforehand?
Right, you hold the tools to interrogate the fine print.
Exactly.
And equally critical, it provides a mathematical imperative to stress test your own holdings.
Exactly. It gives you a reason to log into your brokerage account tonight and run a ruthless audit. Look closely at how your assets have drifted over the last 2 years.
They always drift.
Always. Has a single high-performing stock quietly ballooned to represent 12, 15, or even 20% of your life savings?
It happens so easily.
Have you accidentally dismantled the bulkheads in your own submarine without even realizing it?
Rebalancing those assets is the friction between knowing the guideline and actively protecting your capital. The tools for survival are highly accessible, but the execution relies entirely on your discipline.
Which brings me to one final provocative thought I want you to mull over after we wrap up today. We spent significant time unpacking how the 1943 board established this 5% philosophy to ensure fairness in a highly analog, labor-intensive world.
Right.
Transparency meant putting the fee right there on the paper ticket. But look at the modern trading landscape you operate in right now.
It's completely different.
We are inundated with gamified apps and brokerage platforms heavily advertising zero-commission trading.
The illusion of free execution.
Exactly. If the broker is no longer charging you the standard visible percentage up front, if the commission line item literally says zero, how are they funding their multi-billion-dollar operation?
That's the million-dollar question.
Right. We know about mechanisms like payment for order flow, where your broker routes your trade to a market maker who executes it and kicks back a fraction of a cent to the broker, often resulting in slightly wider spreads or suboptimal execution prices for you.
Right, the hidden mechanisms of extraction have evolved.
It forces a severe reevaluation of what transparency actually looks like in modern finance.
It really does.
Is this modern, frictionless, free trading model actually a victory for the retail investor? Or is the complex behind-the-scenes routing of your data significantly less transparent than the old 1943 standard of just paying a visible 5% toll on the highway?
That's a great point.
Have we simply traded a clearly marked speed limit sign for invisible tax extracted in milliseconds?
It is the ultimate question of market evolution. Because when the fee disappears from the receipt, you really have to assume the product is you.
It's a sobering reality to keep in mind the next time you tap buy on your screen. That is all the time we have for today's deep dive. Thank you so much for sitting down with us and exploring the mechanics behind the curtain. Until next time, keep analyzing the gray areas and keep questioning the fine print.